Hello, and welcome back to DoubleLine's Channel 11 News. I'm Ken Shinoda, your host today, Thursday, October 22nd. The volatility of September seems to be a distant memory, with risk assets performing well so far in October. Major equity indices in developed countries are up around 2 to 3%, and most of the emerging markets complex is positive on the month. However, outside of tech-heavy Asian equities, other emerging markets are still down significantly on the year. Corporate credit spreads have retraced most of the widening they experienced last month, and commodities are also largely in the green. The high-yield index is well into positive territory, up 2% on the year, and U.S. bank loans just turned positive yesterday after a strong month buoyed by demand from the CLO market. As we emerge from the summertime loosening of lockdown measures and enter the colder months of the year, we see global COVID cases continue to rise, especially in Europe. I've heard anecdotal stories of schools in the Midwest opening, only to be shut down again as more cases emerge. Here in the U.S., President Trump and other senior officials were infected with the virus. Although the president recovered and resumed his election campaign, it's unclear if local economies will be as quick to resume business activity to the extent the containment of the virus deteriorates. Given this potential backdrop, it's not surprising that Fed Chairman Powell has recently reiterated his belief that the U.S. economy needs more fiscal support, even though the economic recovery from the natural disaster of the coronavirus pandemic has been somewhat strong. In a speech to the National Association for Business Economics, Powell argued it was better for Congress to provide more rather than less fiscal support, stating too little support would lead to a weak recovery, creating unnecessary hardship for households and businesses. This would lead to more businesses declaring bankruptcy and for households to run into severe economic distress. On the other hand, if policy actions are more than is needed, it will not go to waste. I'm not quite sure about excess government spending not being wasteful, but I'm pretty sure that the market expects and wants a fiscal stimulus plan. Deal or no deal is filling headlines, and stocks and bonds seem to fluctuate on the news. Expectations of a deal and a potential blue wave after the election have helped to push long-term interest rates higher, as the bond market contemplates a Biden victory along with a potential Democratic sweep of the Senate. With Democrats at the helm, spending should surely increase. More spending and higher deficits will lead to more bond issuance and perhaps even growth in inflation. None of those outcomes are supportive of long-term interest rates remaining this low. Across the pond, the Brexit drama continues in the United Kingdom. Last weekend started with Prime Minister Boris Johnson apparently walking away from the negotiation table, stating he will focus on preparations to leave the EU's single market and customs union at year-end without a trade deal, though he is still open to talks if the bloc changes its stance. Then, on Wednesday, the EU and UK announced that negotiations are back on. Sounds like another game of deal or no deal in the works. It seems that global economies and the livelihoods of its populace are at the mercy of global central bankers and governments to maintain growth and economic expansion through a combination of continued monetary and fiscal stimulus. In many ways, we are in uncharted territories. For many global economies, debt levels as a percentage of GDP had ended 2019 at historically elevated thresholds. But 2020 has pushed outstanding debt levels for many countries to new highs, and their central banks continue to purchase financial instruments with no end in sight. Some of the biggest culprits include Japan, Europe, and of course, the US of A. QE1 turns into QE4, turns into QE infinity. Buying treasuries turns into buying agency mortgages, turns into buying corporate bonds, and in Japan, even into buying equities. Fortunately, negative interest rates have yet to plague the US and its banking system. But what more can be done? What are the consequences of these actions? Clearly, near-term gains in financial assets as TINA, there is no alternative, thrives. But eventually, there should be costs for these actions. Shouldn't there be? Here to talk to us about global economies, central banks, their actions, and the potential ramifications is Bill Campbell, portfolio manager of the DoubleLine Global Bond and a colleague of mine I haven't seen in person since March. Welcome to the show, Bill. Bill, thanks for coming in and joining us. Thanks for coming to the office. Is this your first time in the office since March?
Actually, it's the second. I did a webcast a few weeks ago, actually about a week ago with Luz.
Okay,
this is the second time in.
Well, why don't you let the audience know what you do at DoubleLine and a little bit about yourself?
Sure. I'm a portfolio manager for the global bond strategies here at DoubleLine. Me and my team, we focus on countries outside of the United States and investing outside of the United States. The basis for us implementing our investment strategy is more of a macroeconomic process whereby we look at each country and do kind of a deep dive fundamental analysis whereby we want to be able to fully understand what are going to be the main drivers of returns for the currency, the local interest rates, and the external credit of that country. And the way we really do that is countries can be very different. So we wanted to have a way to look at all these countries with very different makeups and be able to compare them and do relative value analysis. So we generally look across 5 different factors on the countries. The first factor generally is what we call the structural factor, but that's more the makeup of the government, what's going on with the fiscal policy, the debt policy, and is there anything specific to that country that we need to pay attention to, like a housing bubble. The second element is growth. So not only what is the makeup of current growth, is it domestic driven or is it driven by an export engine, but where do we see that going forward? We also do a deep dive into inflation. And it's not just headline inflation. We want to understand, the full picture. So we want to look at the employment picture of the country and understand where wages going, and not just not just an assessment of headline inflation, but core and employment. Fourth, we look at the central banks and not only the interest rate policy, but all the fund policies that central banks are looking at globally. So there's a lot of bond buying. There's some currency intervention. And not only do we want to understand that policy, we want to have a view on 1, where it's going, and 2, what are the implications? And then finally, and not least, probably this is one of the most important factors for the currency specifically, is a balance of payment analysis. And what we want to understand is not only what does the trade profile look like for a country, but what do the portfolio flows look like as well. So if you have a country with a large import need, are they able to fund that with long-term foreign direct investment, or is it subject to portfolio flows? And it's that fundamental analysis that helps us build a portfolio of international bonds with currencies that we run here at DoubleLine.
Yep, you guys have a lot going on, a lot of things to look at. I think kind of when we have our weekly calls and you talk about a lot of these other markets, definitely central banks are a big topic, right? And it seems that a lot of the returns that we've seen in risk assets are a function of support from central banks, support from governments, huge amounts of fiscal stimulus and monetary stimulus coming into the system. And I suppose the question is, if things deteriorate, what's kind of left to do there? So what's kind of your view right now on where we sit? Why don't we start with kind of the major areas around the globe, like the U.S., the Eurozone, Japan, and just kind of what room there is for central banks to be effective.
So that is a fantastic question, and actually that really is the question of today. Have we kind of reached the effective limit of central bank policy? It just so happens last week we had the IMF annual meetings where the IMF brings together policymakers, both fiscal policy makers as well as central bank governors, to Washington, this time virtually, to discuss what's happening in the world and what the outlook is. And what you just talked about was the core question. And we actually saw a significant change, in my opinion, in, I think, the outlook for the interplay between monetary policy and fiscal policy, between central banks and the fiscal authorities. The IMF normally has been kind of the world's policeman, whereby they've looked at each country and said, we think that maybe your fiscal policies, running a little bit too loose, and that's going to cause issues of debt buildup, which could hurt future growth. So historically, that's kind of been their role, as well as helping bail out countries that get into trouble. This last meeting, there was a distinct change. The IMF is actually telling central bankers and fiscal authorities to do more. That the biggest mistake that can be made right now is not doing enough. And we know that central bank policies have been pushed to a limit. Not only have we seen rates cut to their effective lower bound, either to 0 or negative 50 in Europe's case, we are seeing extraordinary policy through purchases of all types of assets, not just government bonds. We're seeing purchases of all types of credit assets.
And equities in Japan, right?
And equities in Japan. You knew where I was going with that. And it hasn't really led to robust growth and robust inflation. It hasn't. So what we've been missing over the course of the past decade has been this large fiscal response, mostly because fiscal policymakers, try to save their bullets for a rainy day. Well, the IMF is telling all governments now to use those bullets. But you're getting into like this interesting discussion about our central banks, moving away from their policy of focusing on stability in their markets, focusing on stability of their exchange rates.
Low unemployment, low inflation.
And financial stability. But the financial stability piece, I think, is very interesting because now there's discussion of, okay, is there another element that we should be talking about? Supporting government fiscal policy. So we've seen central banks engage in bond purchases across the globe, not just in developed markets in US, Europe, and Japan, but in emerging markets too, whereby they're starting to fund fiscal deficits. Historically, this has been viewed as a very bad thing, that, especially in emerging market countries, that can cause loss of control of their FX.
That's where you see the big currency devaluations like Argentina and other places like that, right?
Exactly right. So another tenet of IMF dogma has been that currencies should remain free floating and capital accounts should remain open, meaning that there should be free flow of capital in and out of countries. Well, that changed this time as well. Not only are they telling central banks to support fiscal policymakers, they're saying, if you need to support financial stability, we are okay with implementing FX controls and capital account controls.
Okay.
Now, this is a big sea change. I know I've said it a few times, but I just want to underline that point. This means that interventionist policies, are going to, be the issue, I think, of the future for investors, and especially in emerging markets. When we get into, I don't know if it's going to be a 2021 recovery or 2022 recovery, and we start to then think about, issues that aren't so immediate of, how do we support growth and employment during this crisis to, okay, what is the outlook for the country? Well, we're going to be at a point where debt stocks are going to be huge. We're going to be at a point where investors are going to talk about solvency risks and, especially in emerging markets. Is this, does this have a growth model that I can get comfortable with in investing in? And I think there's going to be large differentiation across, the emerging market complex and local currencies specifically, because the currency tends to be the outlet valve.
I recently read Deutsche Bank was talking about this, how the EM countries are kind of doing this quiet QE that nobody really is following, and because it's not as big as, let's say, just the US and Europe on an aggregate basis, but everyone's kind of on this this path of building their debt levels. And right now, as the global economy picks back up, people aren't as concerned about it as in the near term, but eventually those levels could be so high that they're going to cause problems down the line. Right?
100%. And okay, so I think that there are a couple of things to unpack that you said are very important. One, quietly, several central banks have gone and said, we're not only engaging in, the quasi monetization of QE, whereby we're purchasing your debt in the secondary market. Some central banks, such as the Bank of Indonesia, is doing a direct financing to the government. So they're doing
the UK did that too, right?
The UK does it, but it's through the Ways and Means facility. And the way the UK gets away with it, and the way that Indonesia is trying to get away with it, is they say, this is only a short-term borrowing in an emergency facility, and we promise to pay you back in within a year. So you have basically the central banks got the senior claim on the fiscal authorities paying them back first, and that's kind of like the fudge around why. I guess why the market's accepting it. I think that it's something that we need to watch closely. So the UK doing it is problematic, but they're a developed market central bank. They have a lot of the institutional strengths that come with that. Emerging markets are in much more precarious situation, and we're bumping into this time inconsistency problem, whereby the immediate need is for stimulus. So the market, because everybody's doing bad things with this monetization, countries are able to get away with it because everybody's doing it. When we get to a point where we either have a vaccine or herd immunity or something, gets us through the critical phase of this virus, there's going to be a huge differentiation, I think, across the globe as far as, how far down the path countries have really gone. And does that put investors' money at risk to, restructurings and defaults? And, are they going to truly, if we start seeing capital controls go up, what is that going to mean for investors being able to access their money if we invest locally? So these questions, I think, need to be on our radar right now. And unfortunately, these questions historically have been, the realm of just emerging markets and mostly frontier countries. So we're thinking about African nations. This crisis pulled all of that, across the globe. And, I think this was a good place to start because, COVID has caused many big changes, whether, we're talking about technological changes. We're all, working from home. It's probably the end of brick and mortar, maybe we know it. But as far as global investing, there's a massive sea change too, as far as what is the future sustainability path, both the debt sustainability and the growth models. And these growth models are not clear as to what they're going to be, especially, when we get to China, we can talk about deglobalization. But, as we see the world start to, break apart and become more inwardly focused, some countries who have an export-focused growth model are going to need to be examined very closely.
Well, you kind of see the same thing in the corporate bond market right now. Anybody can get a loan, right? There's been trillions and we're hitting record-breaking issuance of corporate bonds. There's been record-breaking inflows into both not only corporate bond ETFs, but treasury ETFs and things like that. And so when you take rates to zero and negative, it forces the market to go buy other risk assets to pick up yield. And so in the credit markets, they go out the risk spectrum. And in the government bond markets, when things are negative to zero, in the developed markets, you're going to go to EM to go pick up some yield because you can go buy assets that have hundreds of basis points of yield pickup. So in the chase for yield, people kind of forget about the credit in the near term because you don't have to worry about it. So now you've seen everybody, all this capital has flooded to these other places where there's incremental spread pickup. And as things normalize, because you talked about, okay, when the virus goes away, when the virus goes away, you would think growth's starting to pick up, interest rates should start to rise. Guess what? They're already starting to rise in the US, right? And when you can come back into US treasuries and get paid some yield, do you really need to go into those kind of riskier parts of both the corporate credit market, but also the riskier parts of the global bond market, right? And that's maybe when people start differentiating between one name and another, one country and another, whereas right now it's just been this big kind of buy everything in sight because spreads are going tighter, right?
Well, yeah, I agree with everything you said, and I think I just wanted to point out a few sequencing elements to this. I think that there are going to be tremendous opportunities globally. When we do get to the point of seeing growth repair, global growth, starting to stabilize, I think the initial trade will be, to just put money to work outside of the dollar. So the initial, move. Well, we've started to see, the first side of the dollar down trade, the dollar lower trade after March.
And do you think that's largely going to be driven just by the debt levels that we're seeing in the U.S.?
Well, I think so currencies are a relative value game. So when you look at the amount of stimulus that's happened in the U.S., it's been shocking. Also, we've seen the reduction in yields. In March, the central bank, the Fed, basically took away any yield advantage it had against other developed markets. Also, the U.S. has a large current account deficit, and they have a large stock of foreign investment. So in the U.S., we have a large stock of foreign investment that's here domestically. Normally, when we get into the first phase of a growth recovery, what you said actually gets accelerated, that the search for yield and what I would almost call it's the chase for growth. People start to move out of what they viewed as like a safe haven trade in the U.S. and they'll, just say, okay, you know what, we may give Indonesia and, we're going to give, all the emerging markets kind of an initial bid because it looks like that's going to be where the returns are.
Yep.
And that
it's kind of like the catch-up trade, right?
It's the catch-up trade, and that's going to mask the differentiation that's actually happening underneath the scenes. So I think everything you laid out is a good framework for thinking about how we invest going forward. That you're going to have, the initial legs of the dollar, trade lower will be kind of on this knee-jerk. Things are starting to get better. Let's, one, bring some capital back home for the international investors. As the dollar starts to move down, international investors will also look to hedge their U.S. holdings, which they've started to do a little bit. But there's a much longer path to do that.
Yeah, you kind of see it when you look at the massive outperformance of U.S. equities versus the globe. Like all the money has just come here and chased because the U.S. because it's the safest place to be, perhaps, right?
True, and you also have the issue that the U.S. basically houses some of the biggest growth companies, on the planet. So
the
when
FANGs
we look
of the world, yeah.
Correct, and so going forward, when we think about some of the other global trends that are happening, like deglobalization, China has been doing a real push to try to focus on building an internal technology infrastructure of their own. Like they've relied a lot on inputs, not only from the United States but from around the world to assemble technological goods and then and ship them back to the globe. But they've realized, as we've realized with PPE and other items, we have a vulnerability to China and their willingness to supply us. China has a vulnerability on the tech side, and China wisely, they have targeted inclusion in equity and bond indexes. And their goal is they're trying to catch up on that technological side, but they're also trying to attract more investment. And they're going to, by getting included in the indexes, they're going to get a lot of passive flows, into their country, just because a lot of passive index investors are going to need to meet those, those allocations.
And not surprisingly, the Asian equities are massively outperforming other
Exactly
EM
right.
because they've got Tencent and Alibaba, and they've got these growth tech companies, within that index that sits in.
Exactly right. So you have these flows that are going to help support China. Mm-hmm. It's going to help support the currency remain relatively strong. And Chinese policy is one of the places where there is some room is China. So likely you could see some more gradual appreciation of the Chinese currency, which we have been seeing over the past couple of months, and that will also put some depreciation pressure on the dollar, and that tends to help support the emerging market countries in their orbit. So you're looking at a lot of elements that are building for a structural dollar bear case, but in the near term, we need to just acknowledge that, there is a big gulf between where fundamentals are and where valuations are just across, I think, almost any asset class, mm-hmm. That you look at. And in order for, a real risk correction not to happen, I think robust growth needs to come back. And unfortunately, what we're seeing right now is an acceleration of the virus, of, the COVID virus globally. So, if we do end up in a scenario whereby you get a risk correction, the dollar is going to have, in my opinion, a knee-jerk appreciation due to its, safe haven status.
Sure.
That there'll be another flight to safety trade, in the near term. I'm not sure what the exact catalyst will be, but I can tell you that the growth outlook is getting seriously impaired, especially due to the fact that COVID, is increasing.
Mm-hmm.
And, maybe we're going in, I know there's a lot of discussion about elections being, a potential catalyst, but usually these catalysts are what we're not looking at. Something, it needs to be an unknown. So by definition, we're not going to know, that kind of pops that balloon and all of a sudden.
Just like COVID did.
Correct. Yeah, exactly. So I just point out that we are in a precarious spot, even though our view is for dollar, lower, and that, international markets do have a lot of return benefit right now. There is the risk near term that the decoupling of valuations from underlying fundamentals, that could be popped, and I'm not going to know the exact event, but it presents a real risk that could cause, a dollar appreciation, tactical dollar appreciation in the near term.
Sure. So we talked a lot about central banks. We talked a lot about, negative rates and quantitative easing. From the first time they started quantitative easing, the worries about inflation began, right? I mean, I think back to the global financial crisis and crazy gold bugs out there. Everyone's saying that QE infinity and gold's going to the moon. And sure, gold's done okay recently, but are we finally going to see inflation with what's happening, or or do we need to take one more step? I know you recently wrote a paper about central bank digital currency, and maybe that's kind of the next step needed to get that inflation, right?
Yeah, so I think the inflation debate is so interesting right now, and I fully believe that near-term deflationary pressures are going to continue to be here. And I wrote a paper. It's Pandora's Box of Digital Currencies. You can find it on DoubleLine.com, where I try to lay out some of the structural elements of the current disinflation environment. And the potential for these new central bank digital currencies to break this framework that we're stuck in right now. And it's not just the U.S., it's around the globe. Japan has not been able, with all of their QE policies, to generate inflation. Europe, same deal, has not been able to generate inflation. So it's not just a U.S. problem. Ultimately, what I argue in the paper is that QE is, effectively providing liquidity to the banking system, but the banking system isn't willing to lend out that money.
Yep.
So it's not like you're providing cash directly to you and I for us to go and spend. And the issue that we can see this across the globe with the falling velocity of money. You just see that credit creation really isn't happening. And we know that it tends to be the lower end of the income spectrum that saves less and spends more. Unfortunately, the way QE works with purchasing, for example, a government bond from a bank and then crediting their excess reserve account, the bank needs to decide, what are we going to do with that excess reserve? We can either, make a loan, which they're not because they're worried about the
C&I
outlook.
production's down. They're just buying agency mortgages. Right?
Exactly. You work on your NIM, but, or you can market make, or you just you're just saving, you're saving this regulatory capital for a bad day. And ultimately, the loans that are made to institutions. Wealthy individuals get the benefit from they're
going to lend to the highest quality borrowers. Right?
So you get the highest quality borrowers, and then also the financial asset trade that you can use this regulatory capital to help boost financial activity rather than creating new loans. So what is a central bank digital currency? It's basically it's a digital currency. It's an electronic form of money. But what makes it different from digital currencies like Bitcoin that we commonly discuss is it will have the full faith and credit of that government backing it. So the government can create and destroy that currency as it would paper money. It's meant to be used as just a replacement. the interesting thing about it is they can, in a digital format, companies such as MasterCard are offering a platform with which you can. What they want to do is allow a new system of payment of settlements and payments via MasterCard. But let's really think about exactly what this means. It means that the central bank can place money directly into a deposit account of an individual. So you can start to target outcomes if you want. Now,
you can target outcomes by income level. Right?
Correct. So if you want more spending, you can say, we're going to put this directly into, your bank account onto a MasterCard. And the other thing is the central bank can see exactly what you do with it. Unlike paper money, there's a trail. And I know that people are talking about, privacy issues and potential privacy vouchers whereby the government promises not to look at what you do with, a certain amount of that money. But, let's get real. If services, continue to suffer, I could very easily see a situation whereby, the government instructs the central bank to put, digital currency into a debit card that's given to people that needs to be spent within a certain amount of time on
you may not even
services.
need a debit card. It can just be on your
on your Apple
right?
Pay
that's
or
even
whatever.
Faster, right?
Exactly right.
So this is basically Ben Bernanke's dream come true. The helicopter money that he wanted could be upon us shortly.
And that, in my opinion, would break the back of disinflation, because now you would truly have, I think the velocity would go right back up. But what comes with that is, I think what we need to be very careful about is that wall that had separated fiscal and monetary policy all of a sudden gets broken. Now, granted, it's in the realm of fiscal policymakers to decide, who should get stimulus payments. But if the Fed or central banks, are the ones who direct the plumbing, if they've input the plumbing for that, I can very easily see in an emergency situation, either they're granted new powers or they take new powers, to be able to spur emergency payments. And as we know, there's nothing more permanent than a temporary government policy.
And so where does the money come from? It just increases the debt burden
It's just printed. So you have currency debasement issues.
Yeah.
And that actually, thank you for saying that, because that brings...
Does anybody owe it or no? It's
the same as like how, with how we're seeing current printing happen.
Yeah.
Debasement is, again, a relative value game. So if everyone's debasing at the same pace, you end up in a situation where, you start trying to find the least dirty shirt. But I do think that long term, the idea of not only digital currencies, but this new payment system and on a global, on kind of a global format poses another structural downside risk to the dollar, potentially, removing the dollar's status as a reserve currency. And I'm actually in the process of writing a paper on that, which should come out in the next week or so,
okay.
That walks through a lot of those. And for anyone interested, DoubleLine.com will have that up in the next week or so.
Awesome. Look forward to reading it. Why don't we just kind of take a walk around the globe, if you will, and just talk about what's going on. We spend a lot of time focusing on the U.S. You spend a lot of time focusing on some of these other countries. So what's going on in Europe? What are kind of the hot topics right now for you as you think about what's going on there, other than clearly COVID cases hitting very high levels more recently? I saw Germany was breaking records recently.
Correct. Yeah. So it's Germany, Luxembourg. We're starting to see some, and really it's across Europe that we're starting to see, COVID cases increase. And I'll get back to, why that's going to be a crucial element. But I wanted to move to policy. The biggest problem that we've seen in Europe is we have a monetary union without a fiscal union, and there's no central fiscal authority. So the COVID crisis actually brought around, what they call the European Recovery Fund, which is going to be a joint bond issuance to help deal with the, fallout from the pandemic. The problem is every single parliament in Europe needs to approve it, and there are strings attached. So right now we're seeing a lot of the CE countries, Poland, Hungary, especially, and the Czech Republic to a certain extent, being concerned about the rule of law, strings that are attached to, receiving this money. They're concerned about, EU law being supreme to, domestic law, which is also an issue in Brexit, which I know we're going to come to later. So there are some hiccups right now as far as getting that approval to pass this recovery fund. But as the COVID crisis increases, our base case is that eventually the crisis, gets everybody on the same page. Now, there's been a lot of discussion that this is a Hamiltonian moment. This is the beginning of the fiscal union. And I just think we have to throw a lot of cold water on that idea, because just last week, we saw Jens Weidmann from Germany come out and say, no, this is a one-off. We're going to have to think about, what does a post-COVID world look like? And there's going to need to be serious discussions about what we talked about at the beginning. Getting your fiscal house back in order, getting your debt back on a sustainable path. So in Europe, besides the recovery fund, what we're also seeing right now is each EU country is submitting for approval their 2021 budgets. And we're seeing a lot of spending associated with that due to continued COVID crisis. But come 2022, I think Weidmann is just the canary in the coal mine of, I think we're going to be in a situation where we were in 2012. There's going to be a lot of discussion about, the debt accumulation that's happening in the southern countries versus the northern countries' willingness to fund that.
Sure.
So thinking about the euro just on a near-term basis, the euro really is, when we think about it versus the dollar, again, it's a relative value game. And I think, the U.S., when we look at the outlook for fiscal policy, it's, first of all, it's exploded, and it doesn't look like there, is a lot of fiscal discipline that is likely to come in the future, versus Europe's already starting to send rumblings that, yes, we'll respond to the crisis, but we want some, fiscal, normalcy afterwards. So just on that relative value basis, you're going to get, some near-term structural appreciation pressures for the euro, against the dollar. When we think about countries specifically, we're avoiding places like Italy, where I'm not sure when it's going to happen, but I am just waiting for the day that debt sustainability comes back to the forefront, and we're all talking about, Italy being on an unsustainable path.
The pigs will be back.
The pigs, that's a good one. Yeah, exactly right. And
it's crazy. Greece, which was, basically bankrupt or almost bankrupt at one point in time, it just traded like the all-time post-crisis low, right? In yield.
Yeah, it did. And so that gets to your point that there has been a massive chase for yield, the yield compression. So the assumption that Europe is moving to a more sustainable fiscal union underpins the reason for all of that spread compression of the pigs to the German Bund. And what I just said to you is, I don't think that is an appropriate assumption. I think in 2022, that is going to be challenged. And so that's the real risk, in that trade. And what we're doing in our, when we think about, the strategies that we implement here, as far as, European strategies, is we're taking a very hard look at countries, debt outlook, on a one-off basis. And in the case of Italy, we still, even though we've had some spread compression, we're still avoiding that trade, because I don't know the day that discussion comes back into the market pricing. But I think it's a matter of, timing rather than if it will or not.
Sure. Just a matter of when.
Correct.
Well, let's talk about Bojo. What's going on with Bojo in the UK? I just find it amusing how it's deal or no deal there. It's kind of like our deal or no deal here. It's, one day they say the negotiations are off the table, and then it's crazy how there's a Bloomberg headline that's like, Mnuchin and Pelosi to talk at 3 p.m. and the stock market rallies, right?
Right. Well, that's such a great analogy, because we go in, we're watching the same Bloomberg headlines come across that it's the EU and UK, trade discussions back on, and then when you see cable or you see the Great British Pound rally, and now they walk away and the British Pound goes off, and the similarities are uncanny. But where do we stand right now? The UK is set to leave the European Union January 1. December 31st is their last day, and they're out.
Do you think it was the right call for the UK?
Yeah, I do. And I'll explain it in a second. I think near term, they're going to feel some pain, but I think ultimately it leads to an interesting trade, which I'll talk about in a minute. Right now, let's just focus on the UK for a second. The UK has an issue that they run, fairly substantial current account deficit, meaning they import. They're an island, and they need to import a lot, and a lot of their imports come from Europe. So not having a trade deal with Europe's kind of a big deal, and that's what they're fighting over right now. And when we look at a lot of the sticky, pieces, of what's happening right now, there are really two main elements. There's, sovereignty, and then like this fisheries issue. So allowing Europeans to fish in UK waters is really an issue for France, but France is a big player within Europe. So that's a nice, in my opinion, a nice political chip that the UK has in these negotiations. What the UK wants is the same thing that we were just talking about in Poland, Hungary, Czech Republic, is they want Europe out of their laws. They want to be sovereign. They want to say, we have the right to decide where state aid goes. And state aid is a big contentious issue, with the current deal and what's causing Bojo to walk away from the table, or, to walk away from the table, and then they come back as, Europe seems to say they think that their framework can be compatible with state sovereignty, which I don't know who's going to bend on this one, but ultimately, when I look at where Boris Johnson won an election on basically not just leaving the European Union, but gaining sovereignty back and not allowing European law to take over.
Yeah.
So you'll hear a lot about this internal markets bill. And the internal markets bill in the UK is basically the UK Parliament passing a bill to reinstitute, British laws that, in the past, when they were, in the EU, were governed by EU laws. And this has become a major lightning rod in this negotiation as far as, how much freedom does Europe want to give the UK to be able to, make their own rules and decide, for example, how much aid are you going to send up to Scotland? How much aid are you going to send to Northern Ireland? And does it have to follow, the EU framework for transfers? Or, the UK is like, why should we? We should be able to make that decision. It's an internal matter, none of your business. So, these are some of the very sticky issues. Ultimately, I think that, let's get to the trade. Ultimately, I think what's going to happen is, I would be surprised if a full deal is done. I think that maybe you get some sort of skinny deal, which, that has a lot of meaning, that has a lot of different meanings to different people. And I think ultimately there's going to be a lot of confusion on January 1. Even if there's this quote unquote skinny deal done, no one's going to know what it means. And given the large import need and the current account deficit, you're probably going to have a depreciation of the, of the British pound. I think British assets are going to probably suffer because people just aren't going to understand the state of play. But then I think sequencing is important. First of all, you're building up a great trade because the devaluation, is going to set up interesting valuations, come 2021. And like we said, if all of a sudden in 2021 we start seeing discussions in Europe about Italy and are we going to have an Italian exit and what's going on with their debt sustainability,
UK becomes a safe haven.
UK becomes a safe haven.
Yeah.
Now think about what happened in 2012. The money didn't go to the UK. Money left Europe and it went to Switzerland. And what happened, in Switzerland? Switzerland had to go and peg their currency because it was just appreciating too much. And all that capital overwhelmed the Swiss banking system, which is basically really set up for wealthy individual money. It's not set up for, large structural flows. The UK, on the other hand, has been the petrodollar capital of the world. They're set up. Most European citizens have a Barclays bank account, so they can eat, and they're very, they had been used to multiple currencies, a few decades ago. They're very used to being able to transfer money, between bank accounts in different currencies. So I could very easily see the case that after an initial sell-off, you're setting yourself up for a great trade where you could get a lot of appreciation of the currency. And then also quickly on the rate side, the Bank of England has cut rates to basically their effective lower bound, and now there's discussion about implementing negative rate policy. But when you look at the implementation, the discussion has been really that the Bank of England is looking at how they would implement it. The market took it as this is imminent. And a lot of the the messaging that's been coming out of the Bank of England is like we're not ready yet. So people, I think, are getting excited about a potential rates rally trade that they could implement negative rates, especially in any adverse scenario whereby you don't have a great deal. But if we have a skinny deal, whereby there's an agreement to just small pieces of a trade deal, and that would have a negative impact on the economy. I don't know if the Bank of England has the willingness to do a preemptive move into negative rates, if you have a skinny deal. So the rate side to me is a little less clear than the currency trade, which I think would be
Sure.
Lower first and then higher on the back of that.
Okay. Why don't we move over to Asia and see what's going on in Japan and China?
Yes.
I mean, nothing's been going on in Japan. The rates have stayed stable for a very long time. They keep trying to create inflation. They can't do it. It seems like almost a boring story somewhat in Japan.
Yeah, so boring to you, but a very interesting trade to me. So first of all, Japan got a new prime minister. Prime Minister Abe, had an illness, had to step down, and now we have new Prime Minister Yoshihide Suga, who's come in, and there's there's a lot of discussion as to whether he can reignite Abenomics or not. That I think is that's an interesting topic, but let's put it aside and let's talk markets, like you said. I think the most interesting thing about Japan is the yen as a new permanent allocation as a risk-off trade in portfolios. So for international investors, we were just talking at the beginning about monetary policy hitting its effective lower bound. In Japan, you have a country that has, due to demographics, they have a very large savings among their population, and because of all of the repressive interest rate policy, a lot of the savings has gone abroad. And I'm sure we've seen it here that there's a lot of interest to chase yield wherever it is, and especially internationally. But that creates a very interesting property for the yen, that when you get risk-off events like in March, or you have other type of global risk events,
there is a flight to the yen, and the yen appreciates in those time periods.
So people bring money back home. And also, because of the low interest rate, it's used as a funding currency, by a lot of hedge funds and cross-currency traders, whereby they borrow yen to, buy another higher yielding currency. And, when you get into a risk-off time period, those trades unwind.
Yeah.
So both of those elements create a very unique a very unique property of the yen, that it rallies in risk-off environments. And when you look at kind of what's happening in Japan, it doesn't really look like the central bank's going to be able to engineer any type of currency depreciation in the near term. So when we're thinking about the 60-40 portfolio allocations, and now that a lot of central banks have reached their effective lower bound, and really what is the upside left in a lot of government curves, well, the Japanese yen is a currency that offers that property, and is something that all investors I would highly recommend look at. And
because maybe you don't have to worry about the prospect of rates rising there, right? Like rates will stay stable.
Correct.
And so in other countries, like just say the U.S., the relationship between stocks go down, bonds go up could be changing as the debt burden increases, and potentially puts more pressure on rates rising just because of the bond issuance coming into play.
Well, you also have explicit yield curve control. So on the 10-year, they're pegging.
They're pegging it. Yeah.
Yeah, and I mean, maybe we'll do that in the U.S. So you've really just got a currency trade there.
Yeah.
So anyway, I think that from just an asset allocation standpoint, it seems to me to be a very compelling trade that people should look at. Or actually, I think it's more of a long-term allocation that investors should look at, not necessarily to pick up yield, but to barbell against some of the trades where you can pick up yield versus what you normally would use your treasury allocation, your global treasuries allocation for.
Okay. And then I guess lastly, China. We finally saw some growth numbers. Who knows if they're real or not?
Well, okay. So China, I I think they did stimulate like crazy over the past couple of quarters, and that has been one of the least reported aspects that's been benefiting, let's call it global markets and global growth. You saw, they by far right now in the third quarter, they just put out GDP at 4.9% year over year. And that's like a 5% growth number. That's relatively strong. Now, like you said, we can question whether that's true or not, but I think the signaling of the direction is right. That they pushed all of the old policy levers in order to support their economy during COVID. Plus, they got an export boost by being the world's exporter, not only of PPE and of healthcare items, but also of technology. So they had the double benefit of being able to benefit from the health crisis in COVID and from the work from home crisis caused by COVID. Today, the central bank policy makers are all coming out and messaging that stimulus is done. The support that we saw through the investment channel, needs to be rebalanced. We're still seeing weak consumption in China, so they're trying to, focus their policy to be a little bit more balanced, move away from that old SOE infrastructure-led, investment-led growth that they just had to throw everything they could at the problem to trying to benefit their long-term growth outlook going forward. So I think that's going to be a structural headwind in the coming quarters, to the macro outlook, for the globe. And I think that it's going to be interesting to see the balance that China is playing on the global stage. We're not in the local when we think about local strategies. We're not investing directly in China because the capital account is still closed, for the most part, for domestic, individuals taking money out, and we're concerned that the willingness to gate capital is still there. So we're not ready to put investors' capital to work in domestic China at this point. So we look at China as it impacts the macro outlook and the global growth outlook. So as I said, as far as growth, I think their willingness to be the underlying one of the strong underlying engines is starting to pull back. But on the currency side, they've been willing to allow their currency to appreciate, and they've been fixing lower, which has the benefit of helping currency trades in other emerging market countries, especially in that orbit. So China is going to be a delicate balance, of the, let's look at the growth policy, let's look at the currency policy, and then the wild card is what is the international policy? I know there's a lot of concern about not only the U.S. relationship with China, but Australia's relationship with China, Europe's relationship with China. And then also, when we think about international investments, they have been a big financier for all of Africa. And if we're going into an environment where restructurings are going to happen, especially in frontier countries and in Africa, I think China is going to be a major player around that table going forward. So in the near term, I think China, as always, gives us a lot of crosswinds. There are going to be some potential opportunities, I think, to play proxies in the emerging market space on the currency side. And I think we need to pay really close attention to the policy outlook from just the global macro standpoint.
They're a huge part of global GDP. So what they do totally affects the rest of the globe.
And linked to every economy.
So it seems like the big themes you have out there are longer term dollar weakness, maybe some interesting opportunities after Brexit passes and the world heals from COVID. And to keep your eye out in Japan, it's not so boring, and it could be the sleepy safety that you find in your portfolio. Is there anything else you wanted to touch on? Or we got a couple questions from the audience, that non-global macro related questions. The first one is, if you weren't in investment business, what would you be doing?
I've always, I'd probably be doing something in the technology space. I got my master's in math. I've always had kind of an interest in, I think it'd be more in like AI, machine learning. I've, taken some, just out of personal interest, some courses, and I just out of pure fascination, I love geopolitics. I love finance, and as far as like machine learning and kind of that let's call it statistics as applied to the world. I think it would be something in that in that arena. I don't know exactly, but those are where my interests lie.
I don't know what I'd do. Maybe I'd win the lottery and I can open a restaurant and entertain people. Oh, I've been doing this a long time. Sometimes you don't know what else you'd be doing. I used to play guitar, so maybe I'd be doing something related to that. Questions for the audience. Question number 4: did you vote yet? What on the ballot bothered you the most?
Oh gosh, that feels like the third rail. I did vote. In California, there are a lot of propositions, that are put on the ballot, and the way I generally look at them is, if the government's asking for a new regulation, I always say no, and if the government's asking for money, I always say no.
Those are good points. Sometimes I, just to be a little bit more lighthearted, I feel like in the local elections, I never know who anybody is. It's like, there's one person I knew was my friend's mom's running for our city council, so I voted for her.
There was a community college board people. I didn't vote on any of those because I didn't know who they were. And the judges, those are, I generally what I'll do is I'll look for prosecutors and then I'll try to look at their background because at least they've been in the courtroom.
Sure.
But I agree with you. There's so many people who it's like, it's so hard to know who they are.
What's a hobby activity that you enjoy?
Oh, well, I have young kids, so my free time for hobbies, has been removed recently. But I think really my hobby time is spent with my family. Whether as I said, my kids are young; they're 3 and 5, and if I have free time, it's whatever they're into. There is no
free time with little kids.
It's whatever they're into because it's fun. Like I think it seems like there's a new stage. Like there's always something. Whether we're like Will's not quite able to ride a bicycle, but we got him like a pedal car. So I guess it's just kind of keeping up with the latest trends that they're into.
Yeah, I used to like surfing, but because of COVID, there are so many people that are trying to take up surfing and other sports that like it is a zoo out there these days. So I don't know. Hopefully the weather gets cold and that starts scaring them off.
So too many people
too many people.
Sunset.
Well, you can just go buy one of these wave storms from Costco for $50.
Is that what these people like when they're just out and they're like hydroplaning basically on the board? Is that what that is?
No, I mean they're just a cheap foam surfboard, and everyone can buy them. And so
I've seen these. We've been to the obviously the beach is the only thing that's open, but they're these cool new. It looks like a surfboard that has an engine. Like on the bottom, it has a motor on the bottom of it, and then it's got it's almost hydroplaning.
Yeah, that's the one Zuckerberg was videotaped on.
Oh, was he?
Yeah.
Well, they're
that's
right off the coast here too.
More people in the water. What advice would you give a new employee at DoubleLine?
That's a good question. For anybody young, I'd say follow what you're interested in. I mean, this life is short and the hours during the day are long. And if you're doing you got to do what you love to do. Like,
I think that's right. Otherwise you're going to make you miserable. So the sooner you find out what that thing is that you really enjoy doing, then you can kind of go after it with all your intensity. Right?
And
that's how you're going to be successful.
It doesn't matter what it is. You're going to be successful. Like, I think that's I think there's a lot of fear that, especially when you're starting out, you don't want to make a wrong choice. And so the wrong choice would be doing something because you think it's the right choice and not because you love it.
What advice would you give the next Fed chairman?
Wow. Well, I think, yeah, that's a great question.
I mean, how can you outdo J. Powell Burr?
That's a tough question, but I would say, be independent, and I think stick to what you believe in, and
I'd say maintain the integrity of the Fed, right?
I think that you have to, and because there's so much pressure, and especially as we discussed, like even now, globally, that central banks are being asked to help fiscal authorities, and
because in the global financial crisis, there was the evil banks to blame, and now the moral hazard has somewhat been removed since it's the pandemic and nobody caused it, right?
Well, what's going to happen? So the central banks bailed out financial assets this time around because they were, the response to the COVID crisis was overwhelming and fast. And I think as we go forward, if we realize a growth recovery that's much lower than what's currently anticipated, we have this big divide between where financial assets are and where that recovery is. And central banks, like you said, I think the moral hazards are the genie's out of the bottle. So I don't know if I would like to see someone who has the stomach to, kind of allow, obviously
allow markets to reprice, basically.
Allow markets to start to clear, more appropriately. So that's going to take. That would be my advice to whoever's there, because ultimately that leads us to a more sustainable path going forward, and I think that would also help, the growth outlook. But I guess. We'll see how, we'll see who actually gets appointed if, when Jay Powell's term is done, and what they believe in may not be what I believe in.
Sure. Well, thanks again for coming in. I hope our listeners and viewers enjoyed learning about the global markets this time around. Thanks, and we'll see you next time.